Hi, this is Adam Khoo here, and I'm going to do another quick market update, seeing an interesting thing that happened when the market closed yesterday, the US markets. And we had something interesting. We had the biggest one-day gain in history. The Dow Jones rallied 1,000 points, biggest single-day point gain ever, which was something which I expected, which if you watch my previous video, how not to get effed by the markets, this is exactly what I said would happen, right? So we are in a bear market right now. If you've been following my videos, okay. So we are on a confirmed downtrend bear market. The 50 moving average is below the 150 moving average, and the price is below the 200 moving averages. Moving averages are sloping down. Remember this: whenever the price is below the moving averages, and the moving averages are sloping down, that's a confirmed downtrend. And on a confirmed downtrend, the moving averages act as a resistance level. So the price could go up a bit, but it would likely hit the moving average and go back down again. So I mentioned in my last video that I expected a bit of a relief rally, right? Because the market has been going down non-stop for over 10 days, right? 10 days of non-stop red candles. It's oversold, you'll tend to bounce. Remember that in a bear market, on a downtrend, prices don't drop in a straight line. How do they drop? They drop in wave patterns, right? So it drops and it has to go up and rally before dropping again. Rally, dropping again. So what you're seeing now is this, okay? This is a rally, okay? Now the question people ask would be, hey, could this be a change to a new uptrend? Could this be a reversal of the trend, or is this merely a dead cat bounce? So again, what's a dead cat bounce? Dead cat bounce would mean goes down, bounces like a dead cat, people buy, thinking it's a recovery, and boom, goes back down again, it's screwed again. All right. So right now it's too early to tell if this is the start of a new bull market. I don't think so. Okay, and I'll explain why. I believe that we'll go up a bit more, and then we'll go down again, and then we will reverse trend. And I'll explain why I think so. Again, no one can predict the future, so this is purely based on technical probability, right? So whatever you do in the markets, always have a stop loss, always manage your risk. So you don't have to be right all the time. You just have to be right more than you're wrong. And when you win, you have to win more than you lose. That's the key to it. But we can't win all the time. We can't predict the future. So with that, let me tell you what is, how I'm reading the market, how I'm playing with the markets, right? So as many of you know, I have been short, all right? So the moment I saw the downtrend pattern, I started shorting the market. And what happened was about 2 days ago, I started to take profits on my short positions. I closed my short positions. Why? Because I knew that it has gone down so much. I'm already making so much money on my put options and my short ETFs that it can't go down forever. It has to rally back up, right? It's like a rubber band. You stretch, it's got to snap back. It's got to snap back before going back down again. So 1 or 2 days ago, I started taking profits on my short positions. So I started to remove my short positions and I took my profits off the table. If you went to my Facebook page, you see that I made some good money when it went down. And then what happened was yesterday when the market started to reverse, I started going long again. I started buying some call options to catch the bounce up. All right. But I'm going to tell you right now that when I'm going to take profits on my call options, when I'm going to, get out, anticipating it's going to go back down again. Right. So how do I tell? So here's how I tell. Again, on a downtrend, we have got the impulsive wave down. Okay, we call this A to B. That's the impulsive wave down. So after A to B, we will have a short-term rally to C. All right, and then boom, you'll go down again. Most probably. Again, I can't predict, but that's my anticipation. Okay, so if you take A to B, let's imagine this is 0 and that's 100%. How much would it normally retrace? Okay. Usually it would retrace to 50% of the move. So for example, if A to B is 100%, you'll retrace to about 50% of the move before going lower. Or it could retrace to normally a maximum of 61.8%. We call these the Fibonacci levels. So I'm watching the 50% and the 61.8% Fibonacci level. Now at the same time, here's another clue. The moving averages act as a resistance level. So when the price goes up, the first thing that will happen is it could find resistance at the 20 exponential moving average, the 20 EMA, which is this red line over here. So watch the red line, okay? And the next level of resistance would be the 50 moving average. So 20 and 50, remember those two numbers. So this blue line that you see here, this blue line, that's the 50 moving average. The red line is the 20 moving average. So what I'm saying is when the price reverses, if it hits the 20 and it can't break, it goes down, we're going back down again. So that's where I'm going to take profits on my long positions, on my call options, which is a short-term trade. If you can break above the 20 moving average, it will reach the 50 moving average. If you can't break the 50, then you will collapse back down again. All right. So based on that, where do I think this rally will go to? Where do I think the cat will bounce to before going back down again? So I'm going to use my Fibonacci tool over here. All right. So where's A? A is over there. That's A to B. Okay. So A to B. All right. So where is C? Okay, so I've got my expansion tool now. Let me zoom in a bit, and now you can see over here, using my magnifying tool. That's not that great. Okay, so over here I have got 50%. Can you see that? 50% over here, and I've got 61.8%. 50%, 61.8%. So this level over here is the 50% level, and that's a 61.8% level. So which means that I expect the price to rally to 50%, and again notice that it is also at a 20 EMA, this red line over there, the 20 moving average. So it will retrace there. If it can't break this level, you'll come back down again. All right, so that's where I'll take profits on my long positions, and I'll start to short the market again to catch the next crash all the way down. Now, if it can break the 50% level, then it could retrace to the 61.8% level. Right, so again, let me draw it for you. That's 50%, and that's 61.8%. Okay, and that will coincide with the 50 moving average. So again, if you can't break the 50, you collapse back down again. Now, if the market can break above the 20 and break above the 50, and the 50 moving average crosses back above the 150 moving average, then we will be on an uptrend again. Now, I don't see that happening just yet. What normally happens is the market doesn't usually bottom at the first go. In other words, when the market goes down, it doesn't hit a bottom and change trend like that. It is not so simple. Normally what the market does, it does a double bottom. So a double bottom goes this way. The market will go down and hit a low. It will go up to the 50% level, which I mentioned, or the 61.8% level, and you'll come back down again, and then you'll reverse to a new uptrend. We call this a double bottom pattern. Now, why does this happen? This happened because of market manipulation, right? So market makers, institutions, hedge funds, they love to fuck the retail investor, right? Or screw the retail investor, right? Pardon my English, right? Pardon my French. So what happens is the market goes down, and as it starts going up, what happens? A lot of the retail investors will start buying here. They think, hey, the market's recovering. They start to buy over there, right? That's when they start buying. And where do they place their stop loss? They will place their stop losses over here, just below the previous low. Now, what the institutions want to do is they want to buy as well, but they want to buy at a low price. So what they do is they will use some of their money to short the market, to flood the market with sell orders, and they push the market down again. And when the market goes down, what happens? It will hit all these stop loss orders, and you'll force the retail investors to trigger their stop loss orders and to sell at a ridiculously low price. So when they sell, who buys? Who buys when our stop losses get hit? That's right, the banks, the institutions, the market makers. So the big guys will start buying over here, and only when they buy, they will rally the market all the way up again. So we call this a forced double bottom. Okay, so what I'm saying is this, simply this: I'm expecting the market to rally up and hit the 50% or the 61.8% level, come back down again to this, and then we could see a new uptrend, a new bull run pattern. Okay, now let's take a look at history and see, has this happened in history before? All right, so I'm going to go back and scroll back and look at some of the recent bear markets that happened. All right, so this is the first one over here. Take a look at this bear market over here. All right, this one over here. So you can see that this was A, right? So A to B. This was the low over there. Now this was C. Can you see that? All right, now if I use a Fibonacci tool, I'm going to click, oops, sorry, let me do it again. Okay, so A to B. All right, so can you see over here? Let me zoom in. What level did it reach? 50%. Can you see the 50% level over there? Can you see the word 50% over there? There we go, exactly, right? So it rallies up, it hits the 50% level and goes back down again and makes a double bottom, and then the new bull market starts all the way up. All right, so always remember, one low, double bottom, goes up. Okay, so what I intend to do, again, I started buying over there. When it hits this, I will take profit on my long positions. I will short the market again. When it goes down, take profits on my shorts and go long again. All right, so that's exactly how you play with the market. All right, pretty interesting, right? Okay, now this was also another very fast bear market that didn't last very long. So again, notice the same pattern, right? It goes down, it rallies, hits the moving average, goes down again, and then rallies all the way up. That's another double bottom pattern, right? Again, let's look at the Fibonacci levels. A to B. And this time, where is this level? Let me zoom in. There we go, 61.8%. That's a 61.8% level. So like I said, watch 50% and 61.8%. 50% down or 61.8% down. So that is where you start to take profits on your positions. Okay. Let's go back to another example in the past. Where was another bear market over here? There we go. This is another classic pattern, right? So A to B, right? That's A to B, and then goes to C, and then goes down, makes a double bottom again, and then starts a new uptrend. Can you see that pattern? Right? So goes down, A to B to C, double bottom, and reverses again. Okay, so again, let's take a look at the level. What level was it? Okay, what level was it? Let's take a look. So let me use a Fibonacci tool. So A to B. Here we go. A to B, and there we go. That's the level, right? And what level is this again? Let's zoom in and take a look. It's the 50% level. Ta-da! So remember, the 50%, 61.8% are the magic levels. All right, you go there, slam down again. Go there, slam down again. If you can break above, then we will start a new rally. But like I said, most of the time, it will not rally after the first bounce. It will go down and again hit the stop losses of those people. So people who bought here, they place a stop loss there, rallies down, hits them, and the market goes up because the market is manipulated. So to be a successful trader, you have to manipulate the manipulators. All right. I've been in the market for the last 27 years. I was one of those people who got screwed by market manipulation 26 years ago, and I learned my lesson, right? So from there, I can make money whether the market goes up or the market goes down. And I'm creating these videos to hopefully to help you to cut short your learning curve so you don't make the same mistakes that I made over 20 years ago. All right. So simply put, what do you do right now? Okay, now it really depends. Are you again an investor or trader? Because I have both an investment portfolio and a trading portfolio. So investing is kind of like being married. So in my investment portfolio, I hold very good companies, all right, that I know will go up in the long run. So for those companies, I just hold them because in a bear market, I know it's not going to last. So I'm going to hold them for the long run. But in a short term, as it goes down, I profit by shorting the market, by using put options, inverse ETFs, and shorting the market in this index ETFs. That's what I do. And on my short-term portfolio, what I do is that when the market's going down, I'm shorting the market, right? I short the market during rallies, and I long the market during bounces up, right? So that's what I do. And that's basically what I teach in my value momentum investing course, as well as my professional stock trading course, as well as my forex trading course. So, I love trading. I love the markets. To me, it's not about the money. I don't need the money anymore. And the reason why I love trading is because, every time I trade, it's kind of like I'm playing chess with the rest of the world, to me, making money is just a game. It's a game, right? And to me, it's just a number, right? But it's a lot of fun. And once you master this skill, you're not afraid of the markets anymore, right? You enjoy playing with the markets. You enjoy taking money out of the markets, consistently, every month, every year of your life. So I hope you've enjoyed this little video, and catch me on the next video. I'll do these updates as often as I can. Alright, a final reminder that our Christmas sale is ending really soon. So here's your last chance to grab our award-winning online professional stock trading and investing and forex trading courses at up to 60% discount before prices rise again the next year. So go on down to piranhaprofits.com, enroll in your favorite course, and I'll see you soon in the coaching program. May the markets be with you, and all the best to the new year. Merry Christmas.